I want to dive into this more with Keith Fitz-Gerald, Chief Investment Officer at the Fitz-Gerald Group. Keith, always great chatting with you. I want to start with these two IPOs that we saw this week. They both popped in their opening trades. DoorDash was up over 85%. Airbnb popped over 135% yesterday. I'm wondering how much you see really market enthusiasm and euphoria over the last couple of months really being a nice tailwind for both of these IPOs.
Well, I would use a slightly less polite term than tailwind on this one. I think these are both illustrative of an IPO process that's gone badly haywire. And my worst fear is that a lot of people are going to lose a lot of money here. This is Silicon Valley operating at its finest, creating excitement, creating froth, creating FOMO, and unfortunately creating billionaires for the early investors and founders, not necessarily the investors who think they're getting a bargain right now. In fact, I'm very worried that both shares of both retreat sharply.
All right. So then I hear what you're saying. Do you see any justifications for the enthusiasm that we saw this week for either of these companies? I mean, I know DoorDash has a lot of real questions about what kind of growth it honestly can look to sustain in a post-pandemic world. A lot of its growth was driven by the pandemic. Airbnb has a little bit of a better path to profitability, but there's a lot of regulatory risks and hurdles that are facing that company. Any justifications, do you think? What would the bull case be?
Well, sure. This is a different question because what you've got to ask yourself is how do they get to profits and what does that look like? I think what you want to do if you're an investor interested in these companies is you wait until you've got one, maybe 2 quarters as public companies under your belt. You see what those numbers look like. Then you have better visibility into the guidance ahead. I think Airbnb potentially is a very interesting play because the optics on hotels have changed forever as a result of COVID. I'm certainly not keen to stay in one. I know a lot of people are not keen to stay in one, despite what the market thinks. Now, DoorDash, on the other hand, any 12-year-old with a Schwinn bicycle is potentially a competitor. So I have a hard time understanding how this thing is worth billions of dollars. I really can't, I just can't even compute that one.
Oh, that makes me laugh, Keith. I'm wondering how you classify these two companies, because we've been talking and you and I have even chatted about this, about the rotation out of tech as investors shy away from some of those really big growth names that we saw leading the way throughout this pandemic. And I'm wondering if you see these two companies as a part of those names, or if you think Airbnb is really more of a travel play like Hilton or Marriott, and DoorDash is really a food, play like Yum Brands, for example. Or are you looking at them both as these big tech names that really might come under pressure next year?
That's exactly why I have problems with both of these listings the way they sit right now. The media, not necessarily the media, the media meaning Silicon Valley's media, the dog and pony show that goes out ahead of these things, is trying very hard to convince the investing public that they are tech companies. They're talking about the networks, they're talking about conversion rates, they're talking about subscribers and customer bases. All of these statistics are designed to obfuscate the fact that they haven't got a path to cash. Now, last time I checked, cash is critical to run a business. So I think, I don't look at them as tech companies. I look at them for what they are, which is innovative ways to change the way we already have services. We don't have to stay in a hotel. We don't have to stay in it. We can stay in a tent if we want. The difference is how you get there. Now, Airbnb happens to have lined up lots of houses as an alternative. That to me is interesting. Again, particularly because the virus has changed our optics. Whether or not they're clean, that's a different issue. Whether or not people can make money, that's a different issue. But this is part of a gig-based economy, alternative usage. That's how I really come down on that. Again, DoorDash to me is simply the rawest form of speculation. I don't know how to skin that one. I can't even find a category for it.
I want to ask you about some of those losses that you say investors are definitely setting themselves up for going forward. I'm wondering if you see those losses happening next year, if perhaps right now investors have created a really high bar that they are expecting these companies to meet in Q1 and Q2. And if they don't meet those expectations, we're going to see that pullback then? Or do you think we're going to start seeing, again, right now, DoorDash down almost 7% right now? Or do you see this march in the red to really start right now and just continue over the next couple of weeks and months?
Well, full caveat, I could be completely wrong in my understanding and expectations. So, you got to take what I say with a grain of salt. It's hard to determine whether or not this is going to need immediate fall off or it's going to be a distant fall off. The powers that brought these things public have a vested interest in keeping prices as high as they can for as long as they can. On the other hand, there's all kinds of mechanisms in place to prevent shares from falling. There are the short artists waiting on the sidelines. There's lockup periods. There's all kinds of other things going on behind the scenes the investing public is not necessarily privy to. So I'm really not smart enough to figure out when this is going to happen, but I believe there's a very, very high probability that it will happen.
So looking forward to next year, let's look more broadly at the markets. As I mentioned, all three major indices are in the red right now, but we had seen record highs not too long ago. I'm wondering how you think investors right now should really be structuring their portfolios. We have a coronavirus that is absolutely surging. The CDC director says that we could be seeing 9/11 level of deaths every day between now and the end of the year. But then we also have this vaccine that could be coming out as early as next week, which of course is great news for the economy and great news in this fight against the pandemic. But how do investors really tackle both of those issues when it comes to their portfolios going forward?
That's a very astute question. The first thing they've got to do is ask themselves, can they live with the thought of potential losses? Can they ride out the volatility? Because if the answer is no, then they want to think about taking some money off the table. On the other hand, I am an optimist. History shows beyond any shadow of a doubt that crisis, regardless of the cause, creates opportunity. So this I view no differently, statistically, opportunistically, within the context of the data. I think we're going to emerge into a brilliant period of investment and of returns as people get back out and stay out. Again, whether that happens tomorrow, next month, a month from now, I don't know. My best guess is the economy starts to get back to normal somewhere in the June, July, August framework. People have got to get vaccinated. We got to start traveling. We got to start spending. We got to get restaurants open. We got to get Congress to do its dang job.
All right, Keith Fitz-Gerald, Chief Investment Officer of the Fitz-Gerald Group. Always great chatting with you, Keith. Thanks for some of those insights today.
Thank you.